Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for the next 25 minutes here on Options Guide TV. All right, so we need to get busy. We put in an S&P 500 index butterfly trade on Wednesday. There was an opportunity to get out on Thursday, but the market is now bouncing back. We're finally seeing some signs of life, which is kind of interesting because consumer sentiment numbers came out today and they weren't really good, but the marketplace, I think, has basically anticipated that they wouldn't be good. And maybe they're taking that, buy the rumor, sell the news, or sell the news, buy the room. I don't know, whatever it is in this day and age. What once was up is now down. So, well, here's bottom line. SPX, it's trading at 56.10 right now. And we have 1 day to live on this option trade. And we did this trade on Wednesday. We doubled down because we've done two bearish butterflies that both paid out over the last 2 weeks. So we decided to do another. Well, I decided on Wednesday to do another one. And it's by far the most speculative one because you're doing it on a Wednesday. You have 2 days for this trade to live. And I hate that the market keeps moving against me, but here's the trade. Here's the March 14th expiration. I always want to double check over here. We are out of the money right now, 56.10. The market is showing strength, up 1.6%. We bought this 55.55s, sold two of the 55.35s, bought one of the 55.20s, and the market is moving fast. This was $5 when we started, just before the show kicked off, and now it's $4.20. And you could make the adjustment right now. This is why I said we got to move fast. If I had this position on, and I didn't put this one on, I don't have this one on in my account. I always like to be transparent about that. I would roll this right now into a short put spread. Now, you do got some risk because the market's crazy, but the fact that the VIX is hanging in there above that 20% level, right now it's at 22.44, that fact by itself is a reason why we could probably still do this and get it in, salvage the position, if you will. So what we're going to do is we paid $3 for the trade. Yeah, somewhere close to $3. And we'll call it $3. And $2.80. That's where it was. $2.80. Paid $2.80. So we're going to roll into the short put spread. So let's do it. Okay, here's the way the adjustment would go. Here's the butterfly that we have. We would be selling the most expensive option contract. So that option contract's going to go away. And I'm going to hit sell to open, even though it really would be a sell to close. Okay. Boom. And then that one would go away, and then we'd buy this one to close, and then this leg just hangs out. And now we can bring in $1 to do that. Dang it, it was $2 before. All right, but if you do this, you have $1,000 requirement, well, $1,500 requirement, 15 points wide, and you have $1 of net credit that you can bring into the account to offset the $2.80 that you paid for the trade. A very quick adjustment. The market's got to stay above 55.55, which is a 1 standard deviation move away. Based off of Delta, we're looking at a 15% chance of it actually finishing 1 cent in the money below the 55.55 level. That is one adjustment. And honestly, before the show started, that was $2. And every single minute that goes by, its time decay is going to erode. From this point on in the SPX to the end of the day, ginormous amount of time decay. And that's where it always, it kicks in right at the beginning of Options Guide TV, like every single Friday for the SPX. Okay, now here's a different alternative. All right, I'm going to run to the what if calculator and bring this back. We could bring in a little bit more credit, but a lot more risk. And I don't know if I'd want to do it, but I want to show it to you. All right. So here is our paper trade that we have on. I'll call it a paper trade. Like I said, I didn't put it on in my account. Send to the trade ticket. We have this position right here. Let's go back to the trading tab. This is where we're at. We're back to normal. Now we can sell this one and buy this one. All right. Then that means we roll into two short put spreads or bullish put spreads. Now we can bring in more of a credit, but I don't think it's worth the additional risk. On a Wednesday, it might be something different. But today, if you do it today and the market goes against you, it's really going to hurt because just gamma, extreme gamma, it's going to move against you 1-to-1. But here's the adjustment. Like I said, I got to get moving here because market's still going up. It's up 89. Not to mention time is decaying. Every single minute, time is decaying. The 55-55 now will go away. We have two of these, right? We have two of the 55-35s. So we're going to sell this one. This is what the trade would be. We would sell that one and close that position. Come on. Stop doing that. All right. And then this one would stay the same, but this goes away here. And then we would buy an additional 55.20, $195, $2. Okay. And that would be two short put spreads. So I'm going to move that away. And if you, wow, we almost get our credit back. Okay, so 270. We paid 280 for it. I find I'm amazed by the fact, then this is because the VIX is where it is, that we could do this roll, remove this trade. We're selling the 55. Yep, we're selling the most expensive one, buying the cheapest one in our butterfly. And if the market stayed above our old middle strike, which is the 55.35, right? 10% chance if it stayed there, and actually that's the probability. The last probability was wrong. It's about a 10% chance because you're short two 55.35s. You're gonna have to go back and rewatch this, I think, right? But here's the trade. Here would be the adjustment. If you do this to your butterfly and you sell to close the 55.55 strike, the most expensive option contract that is in the butterfly right now, and you buy to open the 55.20, you do that, you can bring in a net credit right now. I'm going to call it 250. It was 260 before. Let's go 250. And if the market obviously gave up, well, now we're up 90 points, so we're up another point, 91 now. Then at 250, we paid 280 to put this trade on. We would be down 30 cents. We would have half a day's worth of risk. The market came down to 55.35, then we'd be scared because we have $3,000 worth of risk because we are short two short put spreads in that range. So first of all, you got to have the capital to be able to do this in your account to make this adjustment. I liked the other adjustment, but that was trading for $2. I like that one better because who knows what could happen in this market. The news headlines continue to rock and roll, even in the afternoons, right? Not you usually get most of the news headlines in the morning, but there's anything is possible. And that's where the trade was at. What an interesting trade. You don't, what makes it interesting, and I say that, and I have this like look of amazement on, I'm sure if you're out there in webinar land, now it's 275 down to 86. Yeah, you could get out at even on the trade. Well, at this point in time, you'd obviously need it to expire worthless. But let's go back and I'll show you where. So why I keep highlighting the 55.35 is, remember, this was the middle strike of our butterfly. So we are short two of these. So if we make this adjustment, these two stay, and you have two of these in here, and I guess I can actually add them. You would have those two in here, and then this one would go away. And so when you're all said and done, that goes away. And this is the position. You would add one more of these, and this would be the position that you would have on. And if you look at the delta is about 10. Time decay is huge at this point in time in all of these option contracts. And you would have been, been able to put it, well, this is interesting just to show you this, that you could have put this on for 80 cents right now. But by doing our roll, we're salvaging this at the money option contract that's still trading for $4, which is a crazy amount. And why is it trading for $4? Because the VIX is at 22.5. So you're getting pumped up implied volatility. Like if you look at this near-term option, the actual volatility for this expiration on this day, which the numbers kind of get screwed up with only 1 day remaining, but it's showing you an IV of 40%. That's why this option contract is still there and why you could still get some premium of it. Interesting, very interesting trade, very interesting pricing trade with this put butterfly. But yeah, I'm surprised that we could roll this and salvage and actually get out of this position at zero. Now, we went and did another trade. Now, if you have any questions, I'm looking at, please feel free to put them into the chat box. There's many different ways to watch Options Guy TV. The preferred way for me is through hub.tradier.com, but you can ask any questions. If you do build a sign-on, the sign-on's free. You have access to everything inside the Tradier Hub, and you would be able to ask questions during this event. So feel free to do that. And if you have any, put them in the chat box. Now, my second trade that we tossed out there saw some bullish signs in the chart on Bubba. I mean, there's a little bit of, a lot of talk about China and Alibaba and everything that goes along with it, but the chart looked good. And also they're trying to free up the Chinese economy a little bit. So just in general, the economy's been struggling, and you're kind of seeing some movement on that front. So if we look at Bubba today, that's the symbol BABA. We see that we're up almost as much as the market, 1.25%, $1.77 on the day. Here is the what if calculator. We just did a long call vertical spread. I'll send that to the what if calculator. And our math was really easy on this trade. There it is. Send a ticket. And we are up $1.80. We paid $10 for it, and we could get out for $1.80. I mean, if you didn't want to take the risk on the weekend, that's not a bad rate of return for 2 days. I think that the momentum does continue. I think there is some good upside on the underlying stock, but you never know. You got news headlines over the weekend. Anything can happen once again. But the chart looks good, and just in general, everything about this. Well, there's not a lot of transparency with companies from China, but with that said, we'll see if this momentum continues. We'll keep this one on. We won't officially close it. All right. And then lastly, I wanted to leave you with one trade. Now, I don't like to do SPX trades over the weekends. I don't mind getting bearish as much if we wanted to come back and do another put butterfly. Very amazed that we can actually salvage the position at this point in time and actually get out for break even on it. But, well, you'd have to have some extra capital. And I can't assume that the market won't go down 1.5% before the end of the day. That's what you'd be worried about. But here is a trade in NVIDIA. Now, I did put this on this morning on my shares of NVIDIA, but here's the thing. You have to have NVIDIA. Oh, shoot, the stock's up more now. You have to have NVIDIA. You have to have at least 100 shares to do this trade. I went back and went in great detail with this strategy on anything that in the tech space that's gotten really beaten up. At its lows, well, when this all started in NVIDIA, the stock was right around 140. It ran down to 106, I think was the low point. I could look at the chart somewhere around there, down about 30%. And now it's starting to show some strength. So I have I have more than 100 shares. I'll just put it that way. And if that's the case, and you're willing to sell a call on NVIDIA, which would risk some upside potential, so you got to be aware of that. This is an alternative to that trade. And I like to call it a covered call on steroids. Went out 30 days, went out to the April 11th expiration. And the stock is quite a bit up from when I put it on. So I'm going to have to adjust it a little bit now. So we're going to do this on the fly. Market's at 120. We're going to go a few points up. Let's try the 125. All right. So if we were, so that's $5, $6 here. Okay, that's 6 points higher. I was able to do it and get it 7 points wide for a decent net credit. Okay, if I were doing a covered call in NVIDIA, you are getting 50 vol points. That's the implied volatility level. It's at about 50% right here. The 131 is trading for about $3. So if I owned 100 shares of NVIDIA, here's the scenario that I could do. I could come in and say, I will sell this 131 call, bring in about $3.10, and have a small pillow to land on. I'm saying I'm willing to give up my stock. I've had it for a while. Maybe I don't know where I own it. We almost went down to pre-split levels, right? NVIDIA, when it split, was right around $100. We got down to 106 or so. And now the stock is here. And this is nothing to sneeze at. That's a $300 for your 100 shares. That gives you a little bit of protection on the downside. It's up $5 at this point in time, but you do have that opportunity risk if it continues on up. Now, how about we sell 2 of these? Let's sell 2 of them. And then you say, well, I only have 100 shares. All right, well, then let's buy this one. That makes it covered. This is actually referred to as a front spread. If you look at the options playbook, the thing, and you're on the optionsplaybook.com, what you'd want to put in the search box is front spread, and it will come up. But it is a naked trade. It's saying that you are long 1 and short 2. But if you already have 100 shares of NVIDIA, it's a covered trade. And I went in through great detail on President's Day. If you want to run back to that video, I actually put a PowerPoint together to talk a little bit about the trade, because I think the timing is right. When stocks go down precipitously, if you still are bullish on that underlying, and implied volatilities go up, it makes this a feasible trade to do. And here's the thing. You are now going to be long basically 200 shares of NVIDIA from 125 to 131. You have a long call spread, and then you sold another call. You got it done for a net credit of $1. If we just sold the 131 strike, right, we would bring in $3, because that would be the alternative. If, this is an alternative to a covered call. But now we're doing this. We're only bringing in $1, but we have the potential from 125 to 131 at expiration to add another $6 to that position. And that does a couple of things. First of all, if it starts running up towards 131 and you don't want to sell your stock, well, the gain on the long spread can offset the loss that you might have on the 131 strike call, right? And you could just sell the whole thing and be all right in that scenario. But ideally, what you would like it to do is to slowly start drifting this way and then land close to the 131 level. Now, it's all about, are you willing to sell the stock? Are you not? How you might want to manage that second call if you have 100 shares of it. Are you in a retirement account? Are or are you in a regular account where you have to worry about taxes? There's a lot of things that come into play on that 100 shares of NVIDIA that you had in your account. And you might do it this way too. If you have 200 shares, you do one of these and leave the 100 shares to ride, just in case the stock goes roaring all the way back to the 140 level. You wake up one morning and boom, all of a sudden it's at 140 again. Now, if it goes down, you still got the 100 shares, so you still got risk. And I'm not implying that NVIDIA is definitely going to continue and go back up. There's no doubt about that. Marketplace is still very sketch at this point in time. But you bring in $1. If it goes down, you make $1. You didn't make $3 from your covered call that you sold, but you made $1, right? You made $100 on the trade. And if you throw this into the what if calculator, let's do that. And I do see a comment in here. Send this to the what if calculator. Oh, so Anthony is sharing once again that he did have an opportunity to get out. So that's awesome, Anthony. So we were probably quite a bit down for you to be able to exit that trade at that level, and you're showing that good. So that's what Anthony said. He said he put the trade on, and I did mention that. But I find it very interesting, Anthony, that we can actually roll and have a potential to salvage that position. All right, so this is what the front spread looks like. Like if you were in the options playbook and you looked at the graphic inside my website, you would see something that looks like this. Now, here's the issue is right now you are short 2, long 1. So you have naked exposure to the upside. I would never want to do this without owning the stock. Now I'm going to add the stock, and what's going to happen is this is going to go here, and all of a sudden it's going to go up like this. And it's going to have a capped upside, but not any additional risk if the market goes up. If the market goes down, you still have risk because you have the stock. And that's not anything to do with the options. It all comes from owning the stock, just like in the covered call position. Same scenario. All right. So if I add stock to this, add equity, boom, just like I said, it was like this. Now it's like this. So in this scenario now, you notice here the rise over run is 2 to 1. Now this is at expiration. This is as of today, if you put it on. So it's not going to reward you. It's better that it happens closer to the expiration date. This is if you put it on today, you got 30 days for it to run. But here's what I'm saying is that if you do the covered call and it goes against you, and well, it doesn't go against you, it goes up to the 131 level and it's hanging out right here, you have a big decision. Do you want to see if it continues on up and you get your stock called away? Do you want to roll it? Do you want to just close it and say, okay, I tried bringing that $3 and it didn't happen. I'm going to close it, take a loss on the call option, and have a gain on the underlying stock. Am I willing to do that? Here now, there's still potential to have gain, right? Even if it runs up right now, today, too fast, by the way, I could just sell the whole position and get out. It's such a different dynamic. And I got to emphasize, so you're like, why wouldn't you do this all the time? Well, a lot of times you can't. You got to have the volatility in the option contracts to make this feasible. And the downturn in NVIDIA has caused it. But it is plausible to do this. It's just not plausible to do it on every single underlying, right? So NVIDIA is just this is a very interesting time to be able to look at this type of trade. All right. Any comments on this trade or questions? We'll watch this. I'm really struggling with getting my mouse to grab that. There we go. We'll watch this trade. I will grab a screenshot of it. Now, remember, I'm implying, and I always got to emphasize this, I'm implying that you have 100 shares in your account. Not necessarily meant to be a recommendation to do this at all. I don't have any idea who's out there and what they're doing, and this is always why we call everything a paper trade on Options Guy TV, because it's hard to assess the risk and the knowledge of the person that's watching, right? So you want to paper trade this. If you've never done it before, you just want to watch it. You want to see how it happens and learn. And that's what Options Guy TV is all about. And that's what my book is all about, right? Just want to make you a better trader. All right, I'm going to grab this and we'll watch it. I'll toss it into my note folder and we'll watch it over there. And I actually did it this morning. I did it. Market was down. I think I got a 70-cent net credit, but it's already profitable actually. I did the 121 strike. Yeah, so we're right at that strike. Did the 121 and I was able to go up 7 points and do the 128 on the sale. All right. Any other questions? I'm at time. I said 25 minutes. That's not bad. We're almost exactly at 25 minutes. Last call for questions. And if not, have a very good weekend and do yourself a favor. Turn the TV off. Enjoy the weekend. Don't watch the news headlines over the weekend. We'll find out what happens on the open on Monday. Have a very good weekend, and we'll see you this Monday at 11 a.m. for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.